Hello and welcome to the latest eToro quarterly house view. After a simply fascinating 3 months in financial markets, there can't be a better time than now to discuss it all. And there also cannot be a better three people to digest it all for our investors. Here you can just quickly see the disclaimer, which I'll leave up there for a moment. I am Sam North, a market analyst at eToro and co-host of the Digest and Invest podcast series. And I'm joined by Ben Laidler, eToro's global market strategist, Callie Cox, eToro's US investment analyst, and Josh Gilbert, eToro's market analyst from Australia. Now, before we get into what happened in quarter one, the outlook for quarter two, and much more, it would be great for you all to introduce yourselves quickly for our audience who may not be familiar with eToro or yourselves. Ben, first up.
Hi, Ben Laidler. I'm the global market strategist based here in London. I work with the 15 eToro analysts scattered around the world. I've been doing this 25 odd years, as you might be able to tell from my sort of lack of hair. And that's it.
Amazing. And Callie up next.
Yeah, so hi everybody. I'm Callie Cox. I'm the US investment analyst here at eToro. I am based in Charlotte, North Carolina on the East Coast of the US, and I'm more macro focused. I've been doing this about 10 years with stints at Bloomberg and Ally Financial.
And Josh.
And me to wrap it up. Yeah. Hi, everyone. I'm Josh Gilbert. I'm our market analyst based in Australia, Sydney to be exact. I also co-host the eToro podcast with Sam. I also look after a couple of our other episodes, such as Stockbreak as well. I'm a little bit less experienced than the other two here, so I'm in good company, but I've been doing this for about 7 years with a bit of a focus on equities and crypto.
Amazing. Well, we've got everything covered here, not just the time zone. I think we've got late in the evening in Australia, we've got midday here in London and very early in the States. Now, Ben, for us to really kick off this session and to go into talk about quarter two in more detail, we really need a summary of quarter one. I mentioned it was a fascinating first 3 months of the year. We've got it here on one slide, and your job is to explain to our audience what exactly happened.
Yeah, amazing quarter, right? I guess we did a lot better than we thought coming into the year. It really was the revenge of the 2022 losers. Bitcoin was up 70%, big tech was up 20%, bonds recovered, whilst the winners of last year, the US dollar, commodities, were really the laggards last quarter. Why did all this happen? We basically saw a Goldilocks scenario of less growth fears as the US consumer kept spending, natural gas prices in Europe fell 80%, China reopened after 3 years of lockdown, and this sort of much expected fall in corporate profits, didn't happen. S&P 500 earnings growth expectations are the same today as they were, coming into the year. And this came alongside low inflation. It's now down for 8 straight months in the US, maybe not falling as quickly as we hoped. Jobs markets are still pretty tight, but down enough to give us some visibility on the top of this Fed interest rate cycle. And of course, this is after the most dramatic increase in interest rates that any of us have ever seen. And this is all the necessary first step to ultimately a pause of that hiking cycle and those, interest rate cuts, which, are ultimately to come. This held bond yields down. This helped valuations. And this combination of sort of resilient earnings, higher valuations is what gave us this, this positive quarter. And this came despite this sort of black swan out of left field scare we saw in March. 4 banks failed, and that wasn't enough to derail markets. Central banks responded very aggressively to ring fence the problem. I do think we'll be living with the consequences, though, and I'll talk a little bit about that when I want to talk about the outlook. But if you can maybe just flip to the next slide, I just wanted to maybe put some numbers on all of this. You can see the first quarter performance numbers there on the left-hand side, this so-called reversal rally of the losers of last year. Crypto, tech, Europe, all heavily in green at the top there, and the winners of last year, commodities, banks, the US dollar, are all at the foot of that table. And just as we begin to sort of think about second quarter, you can see that on the right hand side the calendar of the events that are coming up. Earnings season starts soon. We've got the usual parade of central bank meetings, the Fed, the ECB, the Bank of England, but I think they're unusually important right now. We also have typically tougher seasonality. This quarter, April's usually very strong, but May onwards, usually weaker. That's the sort of sell in May, go away phraseology. And we've still got the US debt ceiling to get through. The US probably doesn't run out of money until July, but we're going to be talking a lot about that probably during the quarter. So maybe to the next slide, we can actually get into what we're expecting for the second quarter. In sum, I think everything's going to be faster. I think we're going to see a faster growth slowdown. I think we're going to see a faster inflation fall. I think we're going to see interest rate cuts coming sooner than expected. This is really, I think, the takeaway from the banks scare. We don't have a bank systemic problem, but I think there are consequences. I think banks will now lend less. I think regulators will be all over the banks because of the scare we've just had. I think the way to think about this is it's just going to do a lot of the Fed's job for it. So rather than having more Fed hikes, we're just going to have less bank lending. And obviously, I think the two are going to combine, right? We've had this huge 5% hike in US interest rates. Now we have banks lending less. That will combine, I think, to slow this economies and to slow inflation. Crucially, though, I think this is going to be a net positive. I think these resilient earnings will come under more pressure in the second quarter as GDP growth slows down. But I think valuations will see continued support from these lower bond yields and these expectations of interest rate cuts to come. The relative losers will be those most exposed to this accelerated GDP growth and earnings slowdown. So think commodities, think small caps, think banks. But I think it's a positive recipe for so-called long duration assets, those most benefited by lower economic growth, lower inflation, or at least defensive to it. So these traditional defensives, like healthcare, or new defensives like big tech, bonds, even crypto. And then finally, just to wrap up, my bit on the next slide, you can see what investors are thinking. So forget about, what I'm pontificating here. This is what investors are thinking. We polled 5,000 investors, online last week. You can just compare the results now, which are in pink, versus the December results to exactly the same questions, which are in green. And starting on the top left, you can see this big diversification move. Investors are, less positive on stocks, less positive on crypto, but more positive on, other assets, everything from commodities to bonds to alternatives. If you look on the top right, what are the most favored markets and regions in the world? The US by a mile, but also China, really gaining in popularity as it reopens. Europe also doing pretty well, probably in the back of being the top performing region in the first quarter. Bottom left, you can see the sectors. What are the most favored sectors by investors? Tech still the most in favor by far, but interestingly losing some ground to energy, which is a bit of a contrarian call, and it's been lagging so far this year. Investors clearly expecting some catch up there. And finally, on the bottom right, you can see the themes. Disruptive tech really back in the driving seat in the view of investors, followed by crypto, and these two have really unseated renewables and clean tech, which was the prior leader when we asked the same question back in December. That's it from me. Sam, I'll pass it back to you.
Amazing. Thank you, Ben. And what a difference 3 months makes for markets. 2021 and 2022 were relatively tough for the investor, but the first 3 months of this year, I think will have people smiling a little bit more. One thing that is absolutely going to move global markets is, of course, what happens in the US. Callie, this brings us to you. How are you seeing it at the moment? What are the main things that you're focusing on?
Well, the US was kind of the chaos agent of Q1, right? We were the underperformer. We were the one with the most prominent bank issues here. And we're heading into a Q2 with a lot of black swans on our plate, let's be honest. And the title is a bit misleading. The first thing that pops out to you here is stocks to potentially rise. I mean, honestly, we have no idea what will happen with any stock market. Nobody has a crystal ball. But the reason why I put it there is because I think that we're underestimating the contrarian view at the moment. So right now, a lot of bad news is factored in. We had a lot of anxious headlines cross the tape in Q1. Obviously, as Ben mentioned, banking woes could accelerate the case for a recession, make everything faster. In the midst of that, the Fed is still eyeing inflation as its main priority. And every day at higher rates gets us one step closer to that recession or that policy mistake. The debt ceiling issues could come to a head in Q2. They haven't been resolved yet, even though they've flown under the radar a little bit. And that's another event that could cause investors to feel a little more defensive. And we're still not sure what else could break after one of the fastest rate hike cycles in history. I'm not here to make you feel bad, but I want you to understand how much bad news really is already factored into these markets. And investors, too, have turned from cyclical and offensive, like we saw at the beginning of the year, to a more defensive stature. And I think that helps us in the long run. So, Sam, if you flip to the next slide, I want to show you something interesting. Okay, so this is a chart of the NASDAQ 100 stocks, average performances, and I sorted them out by size tier. So you can see how bigger stocks have performed relative to smaller stocks in the tech sector. And I picked the tech sector out because it's an interesting one to us. It has a bunch of different flavors. It has your big tech stocks, which have higher cash hoards, stronger profit margins, are some of the bigger stocks in the US stock market, versus the more smaller speculative stocks, the stocks that did well in 2021 and toward the beginning of this year. As you can see in March, the pink bars you can see on the screen, tech did rally, but it wasn't a rally driven by the small and speculative stocks. It's a much different situation than earlier this year. And I think that helps us in terms of sentiment because we don't see sentiment getting stretched. We still see investors as properly anxious, properly defensive. And what that could mean if news turns even more negative is less of a crash and burn sell-off, but more of an orderly move in the market. I think fear helps us here. Fear is a healthy dynamic in this context. And I really think investors and Wall Street are underestimating this as we move to the second quarter. So to sum it up for you, Sam, the US still has a lot of moving pieces to it. And the economic outlook isn't looking great, especially after we saw the banking issues in early March. But at the same time, you have to question how much of this is already priced in.
Yeah, really interesting. And for some of those US equity markets, they're now up 20% and more from those quarter four lows last year. It'd be really interesting in the chat. Do let us know if you think that is the low, or is it going to take a turn for the worst in the next part of the year. This brings us up to crypto and tech, and Josh Gilbert here. We're leaving the best for last here. What a quarter one it had been for both of these asset classes. How did you see it? Reasons for it? What are you thinking?
Well, I'm glad we're saying that, right? Because the last time we did this, I had the unfortunate task of talking about crypto when it had the worst performing assets year to date tag. So bit of a turnaround for the books ultimately. Now sat here as the sort of the best performing. Look, it's not easy to ultimately be a crypto investor. And I think that's proved that over the last sort of 18 months. But look, I think the main sort of driver that we've seen from crypto so far this year are sort of the points that both Ben and sort of Callie have sort of mentioned already, which is that the expectations of a faster fall in inflation and a sooner than expected cut to rates in the US, right? We went from at the start of March expecting there to be more rate hikes, I think 2 or 3 priced in at least, with no rate cuts this year. Now markets are pricing in 3 rate cuts this year. So that's sort of seen that investors have taken on more risk. And then on the other side of that as well, we've spoken about those sort of banking issues. Well, ultimately, if investors are feeling, uneasy about sort of centralized banking systems, well, we've seen that they've turned to decentralized systems or assets such as Bitcoin and Ethereum. And I think that was obvious when we saw the rally from both those assets straight after this happened as well. And I think that ultimately, yes, crypto has had a strong run, but we are still down more than 50% from its highs. The lower inflation and those sort of falling interest rate outlook, sort of, as we've sort of mentioned already, we think that that's supportive. I think that really sort of, helps crypto going into the end of the year. We've also got plenty, to look forward to as well from a crypto investor standpoint. Important upgrades across the board with Shanghai on Ethereum. And then we've even got the sort of the Bitcoin halving coming in 2024, which investors are ultimately already positioning for. If we look at sort of crypto and Bitcoin particularly, we do tend to see that they move in cycles, and that 2024 halving is going to be really important as well. We've seen institutional adoption slow down, particularly over what we've seen with events over the last sort of 6 to 12 months, whether that's FTX, whether that's SVB, but I think they're still making headway. BlackRock more recently than anyone, have sort of come out again and have started to say they're going to continue to keep laying that groundwork. I think that's going to be really important. And then, as Ben mentioned there as well, we can see from that sort of, data and also from our retail investor survey, that investors are still keen on crypto. They did buy the dip on these assets, crypto assets in 2022. So they're showing that continued support. And then, moving on to tech, it's very similar to what we've seen with crypto. Ultimately, it's the best performing sector so far year to date, up more than sort of 20%. And that is down to that sort of changing macro environment. Resilient earnings, Ben mentioned it earlier, that hasn't really changed. Tech did sort of come through with some strong numbers there. Valuations were more attractive. But we are starting to see that slower growth from what we saw in previous years from tech. But as I say, those valuations are more attractive. And I think that moves us on to the next part, is what's going to be really important here is balance sheets and profit margins. What we've realized, and if we didn't realize it already with the sort of banking crisis, is that cash is king. And I think that might have accelerated the banking crisis that we've seen, may have just accelerated the likelihood of a recession. But I think the big tech is set up really, really well for a scenario like that. Yes, we've got slowing revenues. Yes, cash flows are probably lower than they were at their peak. But big tech is extremely resilient. We feel they've got plenty of cash to sort of navigate whatever is ahead. Apple is sat on over $150 billion in cash. Google, again, over $100 billion in cash. They've navigated this current period really well with staff layoffs, which, again, is unfortunate to the consumer, but the street are applauding. And they're also benefiting from, disruptive tech that is coming under pressure. So I think that free cash flows for big tech is going to be an important part of 2023. And that will obviously, be the focus of those growth outlooks, especially if we do start to see a slowdown in earnings. But although we're probably going to see that cash not used for a huge amount in terms of M&A, I think we could maybe focus towards things like dividends and buybacks, as we've seen with such as Salesforce and Meta just recently. So big tech continues to sort of be that haven for investors.
Yeah, thank you very much, Josh. And interesting there, just talking about Bitcoin, saying it's still 50% from that high that it had before, which of course means it needs to go 100% to get back to that level. And I wonder whether investors actually like the sound of that, despite the journey it's got to get to. Ben, this brings us on to the next part of the webinar. And if people aren't asking what price Tesla's going to go to, or what icon Elon Musk is going to use for Twitter, or where Bitcoin is going to, they want to know about the 2023 eToro investment outlook. How are you seeing it?
Yeah, so I guess just sort of pulling it all together, right? Back in December, when we gave our 2023 view, the view was, positive, but it was going to be a drawn out recovery. The inflation and growth slowdown we're going to take some time. It was basically going to be a sort of transition year before hopefully a much better year in 2024. Now 3 months on, I think that view has just been telescoped and accelerated. A faster slowdown or faster inflation fall, sooner interest rate cuts. So what I thought was going to be a U-shaped recovery, I now think could be a V-shaped recovery. And I think that's positive, right? Markets are forward-looking. I think they're going to look ahead to those rate cuts that sort of typically kick off, the next bull market. We've got a bit of a sort of earnings and growth crevasse in front of us, but I do think it'll be fairly short and markets will look to the other side of that. Clearly, risks and uncertainty are sort of much higher now than usual. So really great to see that investors, becoming more diversified. I think that's the right call. I think we're going to definitely see a pickup in sort of volatility as we work through some of these issues during the quarter. But our focus really is to focus on those assets that benefit from that lower inflation and lower interest rate sort of view. So we're looking at big tech, we're looking at healthcare, which by the way, these are the sectors that the stock market is disproportionately weighted towards, unlike the economy. Stock market's not economies, but I also think it's supportive for things like bonds and crypto, as Josh mentioned. And it's clearly less positive for those assets sort of most exposed to that sort of growth slowdown that we're looking for. So really, the real economy, small caps, which are by far the biggest employers in all economies, commodities and cyclical sectors like banks.
Yeah, thank you very much, Ben. And for the audience listening at home or on the go, feel free to like, share and subscribe if you enjoyed this so far. I'm not going to let them get away without a Q&A though. There is a few questions we need to go through before we get to the end of the webinar. And Callie, you're up first. And it's quite an interesting time for markets at the moment. We just did our retail investor beat, funnily enough, a couple of weeks ago or a week ago. But how are you seeing it from a sort of retail investor point of view and how they're responding to this recent volatility that we have had in markets?
Well, I think the bottom line, Sam, is they've been resilient. They've been surprisingly resilient, at least in the US. And I focus on the US segment of this global survey. But at least in the US, many of them are looking to invest the same amount of money over the next 3 months or even more money. And I think that's a reflection of just how strong the job market is over here in the US. People invest because they have money, and that's what it boils down to. So I do think that that's a reflection of possibly a stronger economic outlook than we're factoring in at the moment. We do see some diversification, though. They're not all in on risky bullish assets. They're diverting away from stocks and crypto. They're looking toward bonds. They're raising cash. They're looking at commodities and potentially other safe havens. So it's not all encouraging, but I think it's prudent. I think retail investors, at least from what we've seen, are managing their portfolios in expectation of lower returns. And that, again, going back to what I said earlier, could be a good sign for the market. They're getting to that defensive stature, and that could help, keep market moves. Could help keep market moves stay a little more orderly if we do see something happen.
Thank you, Callie. And Josh, the next question is for you. And one of the buzzwords from last quarter or 2 quarters ago was China reopening. Now, are you positive on it, negative on it? How do you see it at the moment? Obviously, we've had some recent news from Alibaba as well. Does that affect how you would answer this question?
I wouldn't say it affects it, but I would still say that I'm positive on the China reopening. I think, looking at the Chinese economy, of the scale it is, I feel that you can't not be positive on it. We have sort of seen local stocks come off in the last sort of couple of months since that sort of reopening, since we had that sort of initial optimism. I think that might be slightly overdone. I think that we are still seeing plenty of positivity coming from this reopening. I think valuations are more attractive. We've still got plenty of policy support coming through. We've got improving economic data. We've then got an earnings season in April, which is going to be a key earnings season, I think, for local stocks. It's going to be sort of the first set of reports that we've had since that actual reopening. So I think that's going to be really sort of important. And then you can also look at the commodity side of it. Plenty of optimism here in Australia from, those sort of big mining stocks, also energy stocks on the idea that we're going to see increased demand from China, but also, just that restocking of commodities that obviously Australia is so sort of wealthy in. And then obviously, yeah, as you say, the Alibaba side of it, I think that sort of idea of splitting its businesses into six, I think it took, the market by surprise a little bit, but I think the idea here is to obviously try and unlock sort of more value from the business. And it's not uncommon. We have seen other companies do this in the past in terms of, spin-offs. I think probably the most recent one at the top of investors' mind was Volkswagen with Porsche. So it can be a great way to sort of, spin off, IPO another company, unlock value. And I think if it's successful, we could see more Chinese companies sort of do the same thing. But bottom line, I think there's still plenty of optimism coming from this China reopening, and the sort of the sell-off that we've seen from stocks in the last couple of months is probably slightly overdone.
Yeah, and just on Baba, the market liked it last week. Really strong week. Callie, another question for you. Biggest US risk in Q2? How are you seeing it? And is seasonality, is that one of them as well?
Sam, there are a lot of risks to consider here. And if we're talking just about Q2, I think bank issues are the biggest risk in my mind. Now, I'll qualify that with saying I think the longer term risk is persistently high inflation. But if we're thinking over the next 3 months, I think what's happening in the banking sector and the fallout and cracks that are spreading from that could be the biggest risk in investors' minds. And this is a growth risk too. This is the fact that banks are tightening up their lending standards. They're crimping down on borrowing at the moment, and that flows through the economy because borrowing and banking activity is the heartbeat of the U.S. economy. That combined with a few other black swans that I mentioned earlier, one being the debt ceiling, could really pose a big growth risk to the U.S. economy's momentum, the U.S. economy's strong momentum. You mentioned seasonality though, which I think is really interesting at this point. We are in a seasonally strong period at the moment. April is the second strongest month for the S&P 500, looking back to data since 1950. And it's interesting, we have the sell in May and go away. Everybody says it every year, but on the whole, that hasn't worked well these past several years. The S&P has actually been up between Memorial Day and Labor Day for 6 out of the past 7 years. So I think seasonality takes a backseat to everything else. It's more of a layer that you consider while you're reading through the headlines and the fundamentals. But at the same time, I do think there's something there where low volume has led to a drift higher. I don't know if that happens this year, but I think it's something to consider.
Yeah, well, fingers crossed for another good April. Ben, you always know when there's a really important subject in markets when you've got people that have no involvement in finance in their everyday work messaging you and speaking about banks in this case. Everyone I know is talking about it or has been over the last few weeks, which then begs the question, is it safe for investors to think about going back into that sector, or is there worse to come?
Yeah, so I do think the bank issues are sort of individual issues rather than systemic issues. But as I said, I do think they have real macro, consequences. For investors, this is the biggest stock market sector in Europe. It's the third biggest in the US, so it does matter. But I do think everything has changed for them and not positively, right? So there's no banking crisis, but the economic growth outlook will be slower. So that means less loan growth for them. I think the interest rate outlook will be lower. So that means narrower profit margins for them. And these very low bank valuations, sub 10 times, PE for the sector doesn't look quite so attractive now, right? The sort of recent sector scares just reminded us all why banks trade cheap and the risks attached to that. So I have to say, I'm a lot more cautious on the sector than I was a couple of months ago. And that's even with the view that, the scare that we've had is over a couple of banks and not the system.
Yeah, well, it'll be really interesting, not just on that subject, but also everything else in 3 months' time to review it. Just a quick one for those watching. You can head over to eToro.com/digest and invest for all of the recent podcasts and webinars. And of course, on YouTube, if you are watching, please do remember to like, share and subscribe and leave a comment, which we can get back to as well. Ben, Callie, Josh, it's been an absolute pleasure having you on, and I guess I'll see you all in 3 months' time.
Thank you, Sam. See you all soon.
Yeah, see ya.
Thanks very much.
Take care, everyone. Trade safe.